Welcome to our comprehensive GBP/NZD Analysis Report covering the trading period from October 27th to November 1st, 2025. In this analysis, we'll examine the key market drivers, technical indicators, and trading opportunities for this currency pair. The British pound versus New Zealand dollar has shown significant volatility during this period, driven by global risk sentiment and economic data releases. We'll explore both short-term and medium-term outlooks, providing actionable insights for traders. This report was prepared on November 3, 2025, incorporating the latest market developments and technical analysis. Let's dive into the details. During the analysis period, GBPNZD experienced a notable decline of 1.75%, dropping 406 pips from an opening price of 2.3131 on October 27th to a closing price of 2.2982 on November 1st. The pair reached a weekly high of 2.3207 before falling to a low of 2.2801, demonstrating significant intra-week volatility. The most pronounced decline occurred on October 29th. Driven by strong risk-on sentiment that favored the New Zealand dollar. As of November 3rd, the pair is trading at 2.29846, establishing a consolidation range between 2.2800 and 2.3100. Technical indicators suggest a neutral stance, with the pair struggling to reclaim the psychologically important 2.3000 level. This price action reflects the broader market dynamics of commodity currency strength versus traditional reserve currencies. Four primary factors drove GBP/NZD movement during this period. First, U.S.-China trade talks dominated market sentiment, with optimism surrounding the Trump-Xi meeting scheduled for October 30th, creating a risk-on environment that benefited commodity currencies. Second, the Australian dollar emerged as the strongest major currency, signaling positive sentiment for the entire Antipodean region, including New Zealand. Third, Federal Reserve policy expectations played a crucial role, with markets anticipating a 0.25% rate cut, supported by lower-than-expected CPI data, which encouraged rotation into higher-yielding currencies. Finally, the prevailing risk-on sentiment throughout most of the week, evidenced by equity markets reaching new highs, consistently favored the New Zealand dollar over the British pound. These combined factors created persistent downward pressure on GBP/NZD. While risk-on sentiment generally supported the New Zealand dollar, weak Chinese economic data acted as a significant constraint on NZD gains. China's NBS manufacturing PMI came in at 49.0, indicating contraction in the manufacturing sector, while the rating dog PMI showed 50.6 with signs of weakening. These disappointing figures are particularly important because New Zealand's economy is heavily linked to Chinese demand for commodity exports. As a proxy for Chinese economic growth, the New Zealand dollar's upside potential was limited despite the favorable risk environment. Meanwhile, Eurozone CPI eased to 2.1%, and U.S. 10-year yields rose by 3.1 basis points to 4.027%. This complex interplay of economic indicators created a nuanced trading environment where NZD benefited from risk appetite but remained vulnerable to Chinese economic weakness, ultimately limiting the extent of GBP/NZD's decline. From a technical perspective, GBP/NZD is trading below the crucial 2.3000 psychological level, which now acts as immediate resistance. Secondary resistance sits at 2.3100, with major resistance at 2.3200. On the downside, immediate support is found at 2.2800, followed by secondary support at 2.2750, and major support at 2.2600. The 50-day exponential moving average is providing dynamic resistance, while the 200-day EMA around 2.2600 offers longer-term support. The 2.3000 level is particularly significant as a psychological barrier that the pair must reclaim for bullish momentum to resume. These clearly defined levels create a framework for range trading strategies and provide clear reference points for breakout scenarios in either direction. Great Britain pound to New Zealand dollars price action reveals a consolidation pattern between 2.2800 and 2.3100, indicating market indecision. The pair failed to reclaim the 2.3000 threshold after breaking down during the analysis period, suggesting a potential range-bound scenario. This consolidation pattern typically precedes a significant directional move, making it crucial for traders to watch for breakout signals. Both oscillators and moving averages are showing neutral signals, confirming the range-bound nature of current price action. A breakout in either direction will likely determine the next major move, but traders should wait for volume confirmation and momentum indicators before entering directional trades. The key 2.3000 level remains a critical psychological barrier that must be reclaimed for bullish momentum to resume. Until then, range trading strategies appear most appropriate. For the next 1 to 2 weeks, we expect GBPNZD to remain range-bound between 2.2800 and 2.3100. Our recommended trading strategy involves selling rallies near 2.3100 and buying dips near 2.2800, using tight stop losses of 50 to 80 pips given potential volatility. For breakout traders, watch for a decisive break above 2.3100 or below 2.2800, but confirm with volume and momentum indicators before entry. Risk management is paramount. Limit maximum exposure to 3% of trading capital per position. Position sizing should be conservative, typically 1 to 2% of portfolio value. This cautious approach accounts for the current market uncertainty and the potential for sudden volatility driven by news events or economic data releases. Several key events warrant close monitoring over the short term. Progress in U.S.-China trade negotiations remains the primary catalyst, with any breakthrough or setback likely to trigger significant moves. UK economic data releases could provide support or pressure for the pound, while New Zealand employment data and RBNZ policy statements will directly impact NZD direction. Our probability assessment assigns a 60% chance that the current range will continue, reflecting the market's indecision. We see a 20% probability of an upside breakout above 2.3100, which would likely be triggered by negative developments in trade talks or strong UK data. Similarly, there's a 20% probability of a downside break below 2.2800, which would occur if trade optimism intensifies or Chinese data improves. These probabilities should guide position sizing and risk management decisions. Looking 1 to 3 months ahead, we identify a bullish scenario with 40% probability. This scenario would be triggered by a comprehensive U.S.-China trade agreement, which would boost risk sentiment and strengthen the New Zealand dollar, pushing GBPNZD lower toward our target range of 2.3500 to 2.3700. The catalyst for this move would be improved Chinese economic data, demonstrating that stimulus measures are working effectively. A sustained risk-on environment with rising commodity prices would further support NZD strength. For traders considering this scenario, the recommended entry point is a confirmed break above 2.3200 with strong volume. However, it's important to note that this is the less probable of our two main scenarios, reflecting ongoing uncertainty about trade negotiations and Chinese economic recovery. Our base case is the bearish scenario with 60% probability triggered by stalled U.S.-China trade talks or continued Chinese economic slowdown. In this scenario, GBPNZD would strengthen toward our target range of 2.2400 to 2.2500 as risk-off sentiment weighs on the New Zealand dollar. Entry would be recommended on a confirmed break below 2.2600 support. Alternatively, we consider a neutral scenario involving extended consolidation between 2.2600 and 2.3200 if the trade situation remains unresolved. In this case, range trading strategies would be most appropriate until a clear catalyst emerges. Traders should wait for breakout confirmation with volume and momentum indicators before committing to directional trades. The higher probability assigned to the bearish scenario reflects ongoing concerns about Chinese economic growth and the uncertain outcome of trade negotiations. Several risk factors could significantly impact GBPNZD direction. Upside risks for the pair include a breakdown in U.S.-China trade negotiations, triggering risk-off sentiment, sharp deterioration in Chinese economic data, more aggressive RBNZ rate cuts than expected, global geopolitical crises, or stronger than expected UK economic performance. Conversely, downside risks include a successful comprehensive U.S.-China trade agreement, effective Chinese economic stimulus measures, a commodity price rally, disappointing UK economic data, or resurfacing Brexit uncertainties. Key volatility drivers include policy divergence between the Bank of England and Reserve Bank of New Zealand, unexpected economic data releases from the UK, New Zealand, or China, and broader geopolitical developments affecting global trade. Traders must remain vigilant and adjust positions as these risk factors evolve. Our trading recommendations adopt a neutral to slightly bearish stance, with range trading as the preferred strategy. Position sizing should be conservative at 1 to 2% of portfolio value, with maximum exposure capped at 3% across all GBPNZD positions. Risk management is critical. Use stop losses of 50 to 80 pips from entry, depending on volatility and position size. Target a minimum risk-reward ratio of 1 to 2 on all trades. Leverage should be moderate, with a maximum of 10 to 1 to avoid overexposure during potential volatility spikes. Expected trade duration is 1 to 2 weeks, aligning with our short-term outlook. This conservative approach reflects the current market uncertainty and the potential for sudden moves driven by news events. Proper position sizing and risk management will help preserve capital while allowing participation in profitable opportunities. For specific entry points, consider long positions between 2.2800 and 2.2850 for range trading, or short positions between 2.3050 and 2.3100. For breakout traders, enter long above 2.3200 with confirmation, or short below 2.2600 with confirmation. 6 key discipline points are essential. Always use stop-loss orders without exception. Avoid over-leveraging positions regardless of conviction level. Monitor news flow closely for market-moving events. Exit positions immediately if fundamental conditions change. Size positions appropriately for current volatility levels, and maintain a detailed trading journal to track performance and improve decision-making. Finally, remember, this analysis is for informational purposes only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making trading decisions. Past performance does not guarantee future results.